Assalamualaikum and hello everyone, welcome back. Today we are going to have another tutorial on how to prepare the financial statement for publication. This will involve a comprehensive examples that will include the adjusting journal entries, some full workings, and also the preparation of the statement of financial position, statement of profit or loss, and other comprehensive income statement of changes in equity, and also the notes, the financial statement for the year ended 31st of December, year 4. And this is taking a previous semester's group project for FAR270. This was the old group project, and I've already amended this group project to suit the current syllabus of FAR270 that is effective not only this semester, but it was effective last semester. Let's start. So this is a question. Chase Berhad, a company based in Batu Berendam, Malacca, is principally engaged in the production, trading, and distribution of beauty and healthcare products. So the production of healthcare products for women, such as prenatal and postnatal vitamins, food supplement, minerals, whitening cream, and slimming herbs. Okay, these are the products or the principal business activities. The company uses a periodic inventory system for the inventory. The finance and accounts department now is preparing the financial statement for the year ended. The current year is 31st of December, year 4, to be issued to the shareholders, and the financial statement will be authorized for issue on 28th of February, year 5. So whatever transaction or whatever events that took place after 1st of or on 1st of January, year 5, up till 28th of February, year 5, is going to be considered under MFRS 110. Events after reporting period. You have the trial balance here, which is showing the unadjusted accounts as follows. So you have the trial balance, and whenever you have a trial balance, the first thing that you do, of course, you have read the question, we look at the requirement. First thing is that you need to go and segregate. So when you are asked to segregate, right, what you need to do is to segregate or classify actually the items in the trial balance according to types. So I've already done that. The current asset versus non-current asset if the item is in the soft B, if it's a current liability or non-current liability, or maybe you have income and expenses, which will be in your statement of profit or loss and other comprehensive income. Okay, so these are the classification I've done for you: current asset, expenses, non-current asset. Be careful, the freehold property, is it depreciated or not? That's also an issue. PPE, investment property shouldn't be disclosed together as PPE. They are separate asset. They should be accounted under different MFRS. A current asset for trade receivable, and you need to also look for any allowance for impairment. Long-term investment, so these are long-term investment which are non-depreciable asset. Check if there are any balances to the bank that need to be adjusted, any adjustment to that. The component of income might be the sales revenue, because revenue is part of an income. Gain on disposal are the other income, and if you have rental income, for example, this is also other income, right, depending on the nature of the business. If the principal business of the entity is to give rental, or nature is investment property, rental income, if you come across, that might be your income in terms of revenue from rental. But here, if nothing is stated, there is none about even a rental. Right, so you have the allowance. Allowance is a negative asset account, where negative asset account for trade receivable, Accumulated depreciation is also a negative asset account for the non-current asset. Here for the PPE, negative non-current asset account, because it will be adjusted or deducted against the PPE that are depreciable item. Current liabilities, orange shares are equity. If you come across redeemable preference shares, they are not equity. They are non-current liabilities. General reserve, beginning balance, they're not informed, so probably this one is at the end of the year. But if you have any information on transfer from or to general reserve, that might be this is not yet adjusted, so these are unadjusted for the additional information given here. Retained earnings, beginning of the year, asset revaluation reserve, beginning of the current year, 1st of January, year 4. Remember, our year end is 31st of December, year 4. So this is beginning of the year. 12% loan from Citibank, 100,000. Next, you have the additional information. And the additional information here is additional information that will be relating to the trial balance given. Okay, let's look at the additional information and we can straight away do the adjusting entries for that. Okay, let's do the first one. Additional information number 1. We have the external auditor Shasha Sanda, chartered accountant. These are the external auditor. Has highlighted the following matters involving the company's revenue, and they need to be rectified in the financial statement. Number 1, this is additional information number 1. Delivery order for dispatch of various goods worth 28,000 on credit to Zaini Saidun, that is your customer, was acknowledged. So it was being acknowledged by the customer on 31st of December year 4, which is at the end of the reporting date. Why? As the performance obligation was satisfied by the company. Remember, the reporting entity here is CHSA. However, the transaction was not recorded by CHSA. So meaning to say that revenue should have been recorded because the performance obligation was satisfied, but the transaction was not recorded. To do that, what you will do is you're going to do one journal entry. Remember, we're learning this, so you can just plus minus here, but I would suggest you for purpose of learning, debit account receivable Zaini Saidun, that is the name of the customer. Credit revenues, this is revenue from sale of goods, and what you will, when you do that, your SOCIE will have to be added by 28,000 to the current asset trade receivable, and your SOPL in the revenue section, which is the first line item in the SOPL, will need to be adjusted by 28,000. The second one, company entered into a non-cancelable contract to conduct a 2-day monthly seminar package to its product distributor. So the company is conducting a seminar, which is part of its also service to the product distributor from September year 4, which is in the current year, until February year 5. February year 5 is in the future period. The total amount fees charged from September year 4 until February year 5, that was 6 months. That was 6 months, right? For 6 months period. Okay, therefore the total amount fees charged to distribution over a period of 6 months is 120,000, meaning to say that it was going to be around 120,000 divided by 6, which is 20,000 per month. The contract requires distributor to pay consideration 120,000 in advance. So you need to pay in full the 6-month seminar fee in advance in August year 4. Somewhere in August year 4, these were being paid and received. And it was paid and received, recognized correctly in September year 4. So it was being received, and this is a contract liability because you take the money in advance, but somehow you have not yet finished your seminar. So if you look, the seminar that was being conducted in the current year, only 4 seminars were conducted as at 31st of December, where giving the remaining 5th and 6th seminar were yet not being conducted, meaning that as at the reporting period 31st of December year 4, 2 seminars were still in progress, right? So that 2 seminars revenue, however, you have already taken up the money. You have already collected the money for the seminars that you have not conducted, meaning to say that performance obligation for 5th and 6th seminar have not been completed or satisfied. So what you need to do is you need to go and remove this. So you need to remove the seminar fee for 5th and 6th seminar that was scheduled in year 5, remember, in February and in January. You need to do that in year 5. You need to remove it now. How? Go and remove it from liability. Remove from the revenue. Remove from the revenue that 40,000 because for 2 months, and credit the contract liability 40,000. So that is an unearned revenue. So unearned revenue is considered as contract liability. Next one, newly launched health product costing 24,000 were sold on a consignment. So this is a revenue for consignment sale where you don't sell your product directly, meaning that CHESA does not sell the product directly, but it was sold on consignment, and that was done by Pasaraya Mantop. So Pasaraya Mantop, however, managed to sell 30% of the products that were delivered by CHESA, right? And it was sold off by Pasaraya Mantop to the customer. So if you would notice under revenue from consignment, you will only be recognizing the revenue based on the amount that are sold off by your consignee. You are the consignor, CHESA, and the consignee is Pasaraya Mantop. So remaining balance, which is the remaining 70%, was still kept by Pasaraya Mantop unsold. The product that was sold off is only 30% from this 30,000, right? And however, Pasaraya Mantop notified and retained a 10% commission as agreed in the contract. So the sale by CHESA should also take into consideration the 10% commission expenses that are agreed to be paid to Pasaraya Mantop. So payments for goods have been received from Pasaraya Mantop but were not recorded, and thus consignment revenues have not been recognized in the current reporting period. So if you were to recognize this one, you can see here the information 138, I put a journal here. To recognize the commission expense, you need to do one journal entry, and also to recognize the consignment revenue. For the commission expense, it is actually 10%, right? 10% from 9,000. 9,000 here is the 9,000, which is 30%, right? 30% from 30,000, so you will have 9,000. Out of that 9,000 that has been sold off, the 10% commission is 900. So the revenue that you will earn is not 9,000, even though it was sold off 30%, right? 30% from 30,000 is 9,000. But you will have to consider that 9,000 you earn them, but in total what you collected from Pasaraya Mantop, the money that will be given to you is just 8,001, because the expenses that you need to incur as a result of appointing Pasaraya Mantop is to give them a commission of 900. So this commission should be included under distribution costs. The bank account should have been increased by 8,001 for the consignment revenues that have been debited, but has not been debited, but you need to record, so you debit to the bank, and the revenue from consignment should be added to the revenue later, 9,000. Okay. Next one is number 4. Our auditors realized that some of the inventories amounting to 35,000 has been sold off but was still included. So the goods that have been sold off shouldn't be included in the inventories, and you are informed that the amount was already recorded as sale. So sale has been recorded, no problem, but only that the inventories still include that a particular item. So you need to go and exclude the inventories with the inventories that have been, or sale of goods that have been already taken place. So how? You go and reduce your inventories by crediting the inventories. 24,000, sorry, here it is here. We are doing this retained profit. That was the one from last year. All right, so last year. Okay, can I go back to number 3? Number 3, just now there was one more missing entry, so you need to go and debit cost of sales 7,200. That one is 24,000 times 30%. So that is showing to you the product or the cost of the goods sold. So the cost of goods sold also need to be adjusted. So debit cost of sale 7,200. Don't go and take all 24,000. Just take the 30% that was sold off by Pasaraya Mantop. I'm going back to number 3. Okay, and that will be 7,002. It will have to be adjusted in the closing inventory on consignment for the cost of the goods sold, right? Product. Here is the cost of 24,000. So you need to do that by taking 30% only, because only 30% was sold off. That will be adjusted in the cost of sale and also adjusted in the closing inventories in the SOCIE, by where you are going to add the cost of sale but deduct the inventories. Now only we go on to number 4. The auditors realized that some of the inventories has been sold off, and it was still included. So another entry need to be adjusted. And remember, this was for the year ended 30th of this somewhere that has been sold last year, which is reporting date 31st of December year 3. However, it was still included in the closing inventories on 31st of December year 4. So you need to go and remove from the inventories, right? And that was already recorded as sale. So what you need to do is, since the inventory is part of the calculation of cost of sale, you need to go and adjust the cost of sale in 2003 or year 3, right? However, you cannot do so since the cost of sale has already been expensed off or was already written off to the SOPL. So what you can do is you can go and adjust the retained profit brought forward or the equity balances brought forward. So therefore, to adjust or to go and increase the cost of sale, right? The retained profit brought forward 1st of January here is 135,000. You go and adjust that. How much? 135,000. You realize that some of them has been sold and was still included in the inventory. So 125, and you will credit cost of sale 125. Therefore, when you adjust your retained profit here, you were adjusting the opening inventories. And when you adjust your cost of sale here, you are also adjusting your closing inventories, right? So that has to be adjusted in the cost of sales in the current year, but also being adjusted in the retained profit brought forward, the equity balance brought forward, because this was a prior year adjustment, that where the inventories as at 31st of December year 3 has been overstated, and that was included in the 31st of December year 4. Therefore, you are removing it by crediting the cost of sale. Remove the inventories from last year that was included. Next, we go on to the freehold property. Freehold property is not depreciated. Remember, I put a different color here. Green is for the PPE that were not depreciated. Blue is for the PPE that is being depreciated. For the plant and equipment, 20% per annum straight line basis. Depreciation of plant and equipment was treated as admin expenses and it has not been computed. So it has not been computed means you need to go and compute that, right? So information was also available from the accountant of the company Jupri Unit pertaining to the valuation of properties. Before that, let's do the revaluation of the freehold property that uses the fair value model, right? The revaluation model was used for the property. Therefore, we are going to incorporate the valuation. Next, debit freehold property with the surplus credit ARR. So this fair value is 600,000, and the carrying amount, there is no depreciation, so the carrying amount or the carrying value is 500,000. So the ARR will have to be credited. That is the initial revaluation. So the impact here in the SOCIE is that the PPE will have to be adjusted, where specifically you need to do in your notes to the account, add with the surplus. In the or other comprehensive income in the statement of profit or loss, you need to add this 100,000 under OCI, other comprehensive income. In the statement of changes in equity, under the ARR for property, you need to go and add this 100,000. That is in accordance with MFRS 116. Next, number 2.1 here. As stipulated in valuation report issued by Tolha, Wiley and Chong, which is the professional valuer firm, the company freehold property which is located in Tongkang Pecah Batu Pahat has a fair value of 600,000. That has been done earlier. Now we are doing number 2.3. For 2.3, that was on IP. Investment property is a piece of vacant land which is located in Buluh Kasah, Segamat. The investment property has suffered a reduction. So this reduction shows that there was a decrease in the carrying amount, and that decrease was 40,000. The company adopted the fair value model. So that fair value model, there is no depreciation, there is no impairment. So you just need to compare the carrying amount with the fair value. And if you look, the carrying amount, you don't need to find because that was 40,000 given as the loss or the loss on fair value change, decrease in fair value. So that decrease, debit loss on fair value of IP 40,000, credit the IP investment property. So that loss you can either present as a line item in the SOPL. This is for the purpose of exam, or you can also include this in admin costs. This is a good option if you can put it under admin costs, right? You can also leave it as a line item by itself in the SOPL. So that should be deducted in the line item, meaning that you're going to choose something like this. If you were to do it separately, you can see here, right? Fair value, loss of IP, the one that I just showed at the bottom just now. This one, right? Okay, you can do that, or you can include as part of admin expenses. The next one is related to an item which is under MFRS 110. Under MFRS 110. You have obtained the following information after the company's financial year end. Remember, year end was 31st of December, year 4, early January, meaning within the post-reporting period. Heavy flood has destroyed the company's inventory, costing 70,000. Destroyed inventories were part of the company's inventories counted at the year end. So that is a heavy flood, which is natural disaster. So natural disaster. This is not an adjusting event. This is a non-adjusting event. Because there were no condition as at the reporting period, and this is non-adjusting event, so there are no journal entries required. You can see here, and it will only be disclosed if you are required to do so later in the notes to the financial statement. So there are no adjusting entries. You just need to disclose or provide disclosure notes on the nature of the event and estimates of the financial effect. Next one is number 3.2. Number 3.2, the balance of account receivable includes 900 owed by Saripatul Sarip, a customer of the company. 15 January, Saripatul Sarip was declared bankrupt. So when you were declared bankrupt, the company was declared bankrupt, you need to go and write off the customer as bad debts. And after several lawsuits by the company, and initiated by various financial institutions, it is unlikely that the outstanding amount is recoverable. So you will not be able to get this 900. So you need to go and write off. And this is an adjusting event. Bad debts, and under allowance method, you will write off because of the bankruptcy. Debit allowance, FHR, credit trade receivable, 900. And this should be read together with information number 5.1. Why? Because these are adjusted or related entries. So I'm now moving on to 5.1. Allowance for impairment receivable is to be increased to 3% of the remaining accounts receivable. So this will need you to recall your knowledge from FAR210 regarding the movement of allowance. And I've done this here at the bottom, last part of the question. So what you need to do is find out what are the balance of the movement at the beginning of the year. Find out. That was given in the question here, 9,000. Put it here. Right? Okay. Then you will go and include the bad debts written off just now. Remember, we debit the allowance, meaning that we reduce. That was journal entry number 3.2. And at the end of the year, you are informed in this information number 5. Here, 5.1. You are informed that the allowance has to be increased to 3% of the remaining accounts receivable. So as at the end of the year, your remaining account receivable is 441,000 plus 28,000 plus minus 900. Okay, this 900, you know, this is the bad debts, right? But that 28,000 is actually what you have done much earlier in your first few journals. The first journal actually, the unrecognized credit sales that you need to recognize. So meaning that that is the additional sale. So you will add the sales that were not recorded. You plus the sales. 28, so you'll be able to get the amount, and that amount is what you adjust by 3%. So you need to find out what are the amount here. 3% from that amount is 14,043, and the difference between these two item, these two, which is 9,000 plus minus 900, sorry, 8,001. If you compare this 8,001 with 14,043 with this 14,043, if you compare, you would see that there is an increase of 5,943, and that was the impairment loss. So the impairment loss will have to be charged as part of an admin expenses in your SOPL. So you need to find out the impairment loss, 5,943, if that is an increase. If it is a decrease, let's say the figure here is 5,043. So if it's 5,043, you will find a decrease, which is not 5,943. You will get some other figure, so that would be an other income, because a decrease in impairment loss. But here it is a part of expense. So do that and include that in the admin expense. This 5,943. This 14,043, go and deduct them under your allowance for impairment in the SOCIE later. Okay, we move on to show that effect. So under the admin expenses, you include the figure, this figure just now, which is the impairment loss under your trade receivable. Yeah, you should just report the net realizable value. The net realizable value of 484,057 after deduction of the allowance for impairment. This is the allowance for impairment, 14,043, and these are your trade receivable net amount. Okay, done. Let's look at the information number 4, 1 and 2. Information number 4, 1 and 2. For 1 is on provision because there is a legal liability and the lawsuit was confirmed by the company's lawyer, so there is a present obligation, and there was also a reliable estimate 75,000, and according to the lawyer, the sustain of the injury would cause an estimated damage to be paid by the company of 75,000, and the status of the lawsuit was confirmed by the company's lawyer. So it means that this is going to be a provision for damage. So go and do the journal entry. Debit damage cost you can include under other operating expense, and credit provision for damage. If it's due within 1 year, the provision should be included under current liabilities, or if it's more than that, it will be under non-current liabilities. Number 2, this is a lawsuit that was made by your customer asking for compensation. According to the company's lawyer, the plaintiff might not win the case, so the outflow is not probable because the plaintiff, the customer, might not win the case. As the product was not sold directly by the company, so company does not sell it directly, and the evidence were also showing that the product was still not expired at the time of delivery to the agent. So the outflow is not probable. So therefore, that is going to be just a contingent liabilities that are not recognized. The lawsuit won't be recognized in terms of the accounting treatment. It is just no adjusting entries needed. You just need to disclose in the notes to the account stating the nature of the event and the estimate of the financial effect that we will be doing later in D3 here. Okay, next one. You have item number 5. Number 5, allowance for impairment, done just now. Number 5.2 here is just information that admin costs are also including your audit fees and director's fees. No adjustment needed because it is already included in the admin cost, unless the word here is excluded. So excluded from, for example, then you need to go and add as part of the admin cost. Here, no addition needed. no adjustment needed. This is just information in case you are asked to write notes on profit before tax. So number 3 is the interest on loan from Citibank. So this is an accrued interest. So accrued interest. Therefore, the journal entry 5.3 is here. Debit interest, credit, accrued loan interest. The interest should be part of finance cost. The accrued loan interest should be part of current liabilities. Tax expense is 180,000. Debit taxation with that 180,000, and credit tax payable that will appear later in your taxation as a line item in your SOCIE and also in the current liabilities. Okay, let's do the preparation. So these are the working for the revenue. You're working for the revenue. You can work out now before you start with your SOCIE. Remember, you want to start off with this item 3777 million. But the workings, you can either do it here, but I'm trying to make it more organized, so I'm going to show it here. Okay, so here, the total or the breakdown of this revenue, you can check this here, 3777. Admin expenses, I just need to add up the depreciation and the impairment because these were not yet included. So it will make up 681943. Distribution costs as per the trial balance, and I also include the commission expense on consignment sale 900. So therefore, you can check the journal later yourself, but here these are the item. Other operating expenses, as I mentioned, this is adjusting journal entry 41. Adjusting journal entry 41 is on the provision for damage. Remember, go and check that, which is 41 here, this one. And fair value loss on IP is item number 23. IP 22, sorry. Next, that we have done the journal, you will go and check the adjusting journal. Finance costs, it should be 12 because as per the trial balance was 11. The finance cost, which is the interest on loan, 11, and plus the accrued interest, the last item somewhere here, 1 month interest, which is 1,000. So that would be 12. And your profit before tax 1144,957. Taxation 180. Other comprehensive income is revaluation surplus 100,000. Total comprehensive income. These are your breakdown. If you want to see your expense, I've already done here. You can also do it in columnar form. Your statement of changes in equity. Take note on the prior year adjustment of 135,000. Remember this 135,000 here. This one, yeah, the prior year error. So there was a prior year adjustment. You go and reduce your equity balance, retained earnings, right? And that was also affecting your cost of sale just now. So if you check the cost of sale, that is also available here, 135. Go and check this part. Next, you have the restated balance at the beginning of the year. The revaluation surplus, only the item that you need to adjust. No dividends, no bonus issue, no right issue whatsoever. Should you have that, do so, right? If you have any other adjustment that affect the equity section, bonus issue, right issue, perhaps share buyback, yeah, that you need to also adjust here, or maybe transfer to or from reserve. Profit for the year, this one is from here. This figure is the figure here. Then you have your item for total revenue, total share capital and reserve. The total share capital will be here, and the total the total of this, 4 items here. Next, you have your non-current asset, your PPE, we will work it out later. The investment property, the carrying amount earlier was 620, the carrying amount, but there was this loss, fair value loss. So that reduced the carrying amount down to 580. Long-term investment, no reduction, no changes. Inventories, 380,000 minus 7,002, which is what you have adjusted earlier, right, in your journal entry here. Adjustment on closing inventories for item 1.3. Next one. Cash and bank balances. Yeah, you just need to add the consignment revenue that you receive. You don't go and dispose anything for PPE, for cash. You don't go and have any cash sale whatsoever that has to be recorded. This is just the consignment revenue received that you have not recorded. So you record, done. The 12% loan, no adjustment because we have already done the interest adjustment just now for the loan. Trade payable, no changes. Provision for damage, I include under current liabilities with the assumption that it will be payable within 1 year. Contract liability, there was adjustment in number 1 here, 1, 2, right? You can see the journal entries that I put here. Next to the working section, I have put the working section to explain each line item: accrued interest, taxation, payable. These are your PPE notes. Look at the freehold property, the one at the end of the year here. Should be as a result of surplus only. There are no other addition or disposal, not even a derecognition or any deficit, none, right? No realization of revaluation surplus, yeah, nothing. If you talk about revaluation, also no revaluation surplus realized to be included here. Accumulated depreciation, look at the balance that you have here. It was just as a result of the depreciation charge for the year for the plant and equipment that you earlier calculated. Carrying amount 760,000. Go and check if there is any derecognition, any revaluation, elimination of accumulated depreciation as well, and any adjustment for that. Nothing. So we have done all this. So this is answer for the last part, which is the property, plant and equipment. These are the 3 answers. And these are the notes on trade receivable, movement on allowance that I've already reproduced. And this is from your knowledge in FAR210, right? Then you have your notes for your contingent liabilities. You should also know how to do notes for capital commitment. With that, I thank you for watching. I'll see you in another tutorial example on preparation of financial statement in our next video. Thank you for watching. I'll see you when I will see you.